So today's session is about the tax implications of creating a holding company. I am a little discombobulated, but I will do my best to make this a great session for those of you who are attending. I think everyone who's on this call is a client, so I'm not going to belabor who we are. But for those, if we are able to get this to air somehow, some way, we are CPA for IT, an accounting firm whose mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We are a top 50 cloud accountant in North America, member of National Association of Computer Consulting Businesses, and been specializing in the niche market of independent contractors since 1984, when my father founded the firm. Today's agenda is we're going to talk a little bit about what a holding company is, how to how to set up a holding company, and a couple of different options, what the benefits are, what the drawbacks are, and of course how we can help if you are interested in moving forward. So what exactly is a holding company? A holding company doesn't actually produce any goods or services. Its primary function is simply to hold assets, typically in the form of investments. Those investments can also be other companies, and it can offer some significant benefits like tax savings and asset protection. Um, in most of the situations where we're setting up a holding company, it's so that it can own shares of an operating company, which would be one of its primary assets. Now, there are a couple of ways of setting up a holding company. The method that most of our clients will elect, and what is the cheapest method for setting up a holding company, is to take your existing company, which already has all the assets in it, and turn that from an operating company into a holding company. And that can be as simple as just getting a new corporation. That corporation shareholder would be the existing company, and you would begin consulting and your engagements with that new company, which does mean that there's a bit of a transition period, usually because you don't, most often you don't create that company on the exact last day of your fiscal year end. So usually there's a transition period where your company is still an operating company and a holding company sort of in one. And then in that subsequent year, it remains a holding company. Now, if for some reason you had, let's say, a legacy contract, and you couldn't go to your client and say, "Hey, I'm setting up a new company. Can we can we put that? Can we redo our contract with that new company?" And they might say yes, but the terms are going to change, or who knows? There might be a million and one reasons why you can't just go and set up a new company, and begin consulting or generating your revenue through that new company. So there is an option for that, which is typically done with the Section 85 rollover. However, this is not something that we ourselves can help you with. Typically, you would need to bring in a tax attorney to help with those types of restructures and rollovers. We can refer you on to someone if you do need to do that. So there are options available, but it is a more expensive option. And for most of our clients, we have set up and structured the original incorporation that we've done for most of our clients with the intent that one day it would eventually become a holding company. Now, when you do set up the holding company, there are a couple of steps that we recommend you go through. So first, you want to review the financial statements and the incorporation documents with a financial professional such as ourselves to determine whether the actual holding company structure makes sense for your business. Typically, what we're wanting to see is there going to be a financial benefit of actually setting up this company? Because we have all too often seen people go out and set up and create holding companies or other structures, with the belief that it's going to be a benefit for them, but all it ends up doing is adding a whole bunch of costs and not generating any return for them. But assuming it makes sense for you, we may want to then process some articles of amendment for your existing company to rename that company. Again, assuming that we're going with that first option, we're going to take your existing company, it's now going to become a holding company, and you're going to create a new company to do your consulting with. Often in those situations, you want to rename your company for just so that it's a little bit clearer and less confusing between your consulting company. But that's not a requirement, recommendation certainly, but not a requirement. We would also recommend that you select a December 31st year-end date for both the operating company and the holding company. Now, normally we don't recommend a December 31st year-end because a December 31st year-end is the most popular year-end, and that means that when you come in to bring in your information, it's going to take longer for your accountant, whether that's us or any other accountant in the world, to process, simply because that's when we're at our busiest. However, with the holding company in particular, where you're typically holding investments, which commonly are things like stocks and mutual funds and those types of things that typically have reporting based on a calendar year, there are benefits and things that will make it easier for your reporting on the investments when it's based on a calendar year. And the other thing that we recommend is that it's often easier to have a holding company and an operating company to sync up their year-end dates. It's not to say that you can't have an operating company and a holding company have different year ends, but it does make it a little bit more complicated and a little bit more difficult. So typically, these are the recommendations that we would go through when setting up a holding company. Now, we've already been through this. Sorry, I'm going the wrong way. There we go. So let's talk about some of the tax benefits of setting up a holding company. So one of the big ones, if you are ever looking to sell your corporation, is to lock in the lifetime capital gains exemption. For those of you who are not familiar with the lifetime capital gains exemption, if you are selling the shares of your business, you can get a portion of the sale of those shares tax-free. In fact, right now it's $971,190 of capital gains would be eligible for exemption under the lifetime capital gains exemption. So if you sold it for 900,000, it would be completely capital gains exempt. If you sold it for $1 million, you'd be looking at, 29,000 or $28,810 or whatever it is in taxable capital gains on the sale of those shares. And that's assuming you had zero cost base. The reason that this is important is because there are some specific requirements for getting a capital gains exemption, that the company must be used for generating ongoing income and not as a holding company. And so a holding company is a form of purification strategy that we use to ensure that you can get that lifetime capital gains exemption. But over and above that lifetime capital gains exemption, because many of you may not actually have a saleable business, a lot of independent consultants, when they stop consulting, the company really ceases to have any value. But there are other things such as estate planning where a holding company can be useful again. Some of the things that we can do is things like estate freezes. And this allows us to basically say, okay, we're going to lock in the value of your business today, and any future growth goes to your children or the next generation, which means less money is going to flow through the estate and be subject to probate, which can save you some money. And you can do a little bit more, you can be a lot more creative in the corporate structures that we're talking about, depending upon your individual needs. But obviously, we're talking here at a very high level about holding companies. And again, if you have a very large estate, this is something you want to sit down and talk with your accountant about, looking at some tax planning strategies on what's going to happen with the value of what you have inside your corporation when passing it on to the next generation. And do we want to consider basically locking in the value today and having any future growth attribute to the children? And that's where another value of the holding company comes in. It also provides a form of asset protection, which means that now if anything were to happen on the operating side of your business, that is completely separate from the assets. So again, things like liability, as well as things like PSB, if they were to come after your operating company and that operating company no longer has any assets in it because they have been flowed up to the holding company, there's very little that those creditors or CRA can do because there's nothing in that corporation. The corporation could be simply bankrupted, and your assets are sheltered and protected inside the separate holding company, which is actually one of the largest benefits that you're going to get. Now, the only problem with this benefit is it's very hard to quantify, and it's not something that you're going to see on paper each year as far as in actual tax savings. Um, the tax savings come in a couple of strategies that we would use. So first of all, what we would leverage is tax-free intercorporate dividends. So what this means is that any money that your operating company is generating, at the end of the year, we're going to take all those retained earnings and we're going to move them up to the holding company with a dividend. Now that's a tax-free dividend. Those dividends would then be invested, and you've only paid 12.2% tax on them here in Ontario, and you're now investing, $88 on every dollar and hopefully generating a return. Now, if that money was kept inside of your regular operating company, if you had more than $50,000 of investment income, each dollar above that would begin to erode your small business deduction by $5. Meaning if you had $150,000 of investment income inside of your operating company, you'd have the $50,000 exemption, and then you would have $100,000 over that. That 100,000 would be multiplied by 5, which is $500,000. And so your small business deduction limit, which is $500,000, would be eroded down to zero. And that means that your income that would normally be taxed at only 12.2% is now going to be taxed at the general rate, which can be upwards of 28%. So it's a significant jump in the tax rate if you do erode that. Now, this is based off of the net investment income. And if we have that, again, all lumped in with your operating company as well as your investments, then what CRA says is you're certainly entitled to take expenses inside this company, but the expenses are going to be applied against the lower taxed income first, and then begin to erode the net income of the investments only after that has all of the lower tax income has been wiped out. And this is going to affect the small business deduction erosion, number one. And number two, it's also going to affect the amount of tax that you pay. And this is typically where you're going to get the financial benefit of setting up a holding company. And that's because the investment income, as we said, is going to be taxed at the general rate. Now, this does depend on whether it's capital gains, interest income, dividend income. Let's talk about interest income and capital gains, which are going to be taxed at the general rate, which is upwards of 28%. So if all the other expenses are applied against your consulting income first, you're paying the full tax on that investment income at 28%. But if you actually move all those investments into a holding company and you make sure that you take all the expenses in there, like your own salary and all the management fees and everything in that holding company, you can structure it so that holding company ends up having hopefully no net income. So you're not paying any of the tax at this higher rate. You're not getting any erosion on your small business deduction. Now, over here in your operating company, because you haven't taken as many expenses, including your own salary, it's going to have more income, but it's going to be more income at the small business deduction amount, which is only 12.2%. So really the advantage you're going to get is being able to move money that would normally be taxed at upwards of 28% down to 12.2%. So you're getting at least about a 16% savings on the investment income if structured properly. So typically what we say to people is you want to have at least $10,000 to $20,000 worth of investment income each year in order for a holding company actually to make sense for your individual situation. Because if you've got $20,000 of income each year, you're seeing a savings of about $3,200 ballpark each year, which is going to more than make up for the additional costs of setting up the holding company. So again, sorry, I forgot to go to this slide, but this is talking about that small business deduction limit again. And the only real con of the holding company is really the cost of setting it up and maintaining it, right? So you're going to have a cost for your articles of incorporation. You're also going to have your cost for your ongoing accounting each and every year. And just because you have two corporations doesn't mean your accounting fees are going to double, because typically you're taking some of the work that was in your operating company and moving it over to the holding company, and you are getting some synergies there. It is going to be an increase, though, over and above what you were paying for just the one company. And so typically what we say is we want to make sure that we're seeing, that level of income to be able to justify the costs of the ongoing accounting fees, as well as the setup and the incorporation. And again, depending upon which method you go through, we talked about earlier, the two ways that you could set up a holding company, the cost will be very different for the initial setup cost. The ongoing cost might be fairly similar, but the initial setup cost could be drastically different. And you want to make sure that you're getting a return on this investment and that it's actually a worthwhile investment for you. Now, of course, if you are considering setting up a holding company, the first step we say is to come and sit down with your account manager. If you're not a client and you're considering a holding company, we would recommend a free initial consultation. Of course, we do have our in-house paralegal team who can help set up the company, the new operating company. Again, if you want to go with a little bit more complicated corporate structure, and if you're considering other things like trusts as well, we can bring in tax lawyers who can help and assist with that as well. And then, of course, all the other benefits that we have that accrue to our clients, which include our benchmarking, our audit protection, and our industry expertise. Now, I've flown through this really, really quickly, and this was indeed a very micro session, and unfortunately didn't get it live either. But I'd love to open it up for any questions that people might have. So if you do have any questions, if you could do your best, I was going to say to post them to the Q&A. I'm not, yeah, there is a Q&A. So please post them into the Q&A if you have any questions. If you're struggling with the Q&A, you can post them in the chat and I will do my best to get to them. But yeah, I'd love to open it up for any Q&A. And if there's no questions, we'll keep this week's session short and sweet. And I'll get on the line with Kasim and see if we can figure out why we can't get this stuff live anymore. Well, it doesn't look like there's any question. We got them. There they are. Should the holding company pay for accounting fees for the other corp? No, they're usually, because there would be it would be a difficult argument to pass with CRA that that's a valid expense for the holding company. So the each company would remain its own accounting fees. Where you've got more flexibility are things like you can think about your home office, your telephone and internet. You have a little bit of flexibility in justifying which company those apply to. And then the big one is really your own salary and remuneration, right? You've got a lot of flexibility in determining which company that those expenses come out of. And you are typically, for most people, able to minimize the investment income and bring it below the thresholds we need just by leveraging the salary and then the normal expenses that would go on with the holding company. So I hope that helps. And got a few more. I'm glad to see these are coming through. Why having to promote an existing company to a holding company rather than creating a new holding company on its own? So it's like I said, it's not that you can't, it's just more expensive. Because in order to do that, you have to transfer over the assets that are in your existing operating company into the holding company. If you just make your existing company the holding company, you don't have to transfer any assets. You don't have to do that rollover that we talked about. So it's not that it can't be done. It's just more expensive to do it, which is why the majority of our clients will just take their existing company that now becomes a holding company, and they'll incorporate a new operating company. But it's not a requirement, it's just a cheaper way of doing it. Difference between a trust and a holdco to protect assets from tax and or differences in tax rates. So a holding company and a trust are very, very different. So a trust is more used for distribution of assets and so that's goes in hand with a bigger estate planning thing. And trusts also provide a whole bunch of level of control. One of the things that my dad always says that he loves about trust is it gives you the ability to rule from the grave. But they're very, very different. We'll probably do a whole nother session, I would think, on trusts. But the trusts aren't going to mitigate and reduce the tax of the investment income that you have. Is real estate investment in property a valid expense for a holding company, e.g., a recreational property that you also work out of? So a real estate investment would be an asset as opposed to an expense. It might have expenses related to its operation and that you could expense. But yes, holding companies often own physical real estate. It's not uncommon. Although the real estate is usually an asset, not an expense. There might be expenses related to operating that asset, and those expenses would be offset against the income that property generates. And also could be revenue generating. Yeah, so absolutely. I mean, hopefully, an investment property would be revenue generating. Now, typically, real estate has got a cap rate of somewhere between 3 to 5%, as you might have seen in some of our past webinars with real estate investing experts. And if you haven't seen them, I encourage everyone to go back and watch them. And cap rate is basically the rate of return after you pay your costs, assuming that you're not doing any borrowing. So if you're borrowing, you can be a negative cash flow with the property, but it would normally, if the property's paid off, be about 3 to 5%, positive cash flow. I had money in OpCo, which I wanted to buy real estate as an investment. My OpCo's retained earnings is low, so it would be hard to qualify for a commercial loan. Therefore, I created a holdco and made an intercompany loan from OpCo to holdco. When applying for the mortgage under the holdco, my personal income comes into consideration by the bank. Does that make sense? So yeah, one of the downsides of buying property inside of a corporation is that, first of all, you typically pay higher rates on mortgages because there's more risk for the banks. And often they'll actually require a personal guarantee because the reality is a corporation can be bankrupted a lot easier than an individual and has less long-term impacts on you as an individual than obviously a personal bankruptcy. So that doesn't seem unusual to me that the bank wanted a sort of personal guarantee from you because there's probably not enough history or not enough value in that corporation for them to feel comfortable with the loan. So they wanted some personal guarantees. So that's one of the things we also didn't talk about holdco operating companies. When you have that kind of structure, there are abilities to do loans from one company to the other. And these are intercompany loan accounts. They do have to always be balanced and be the same amounts, but they're usually interest-free loans that can be tracked, that always have to be tracked on the balance sheet. And the thing is, though, that you want to keep in mind that typically, I mean, if there's no retained earnings, and you had a whole bunch of money in an operating company, it would be done as a loan as opposed to a dividend. Although the other question then is, why do you have a whole bunch of money inside of a corporation with no retained earnings? But we'll leave that for private conversation, maybe, because I'm assuming you've dumped a lot of personal money into it and you've got a big director's advance. And what I would say in that situation, I'm not sure that that's a good strategy in this day and age, with the new rules about capital gains inclusion rates going up. Because personally, you would have a capital gains exclusion rate, um, and you would have an exemption amount. That exemption amount doesn't exist inside of a corporation. So, I mean, maybe if you have other um, capital gains that you're receiving personally, that would make sense. But otherwise, putting money into a corporation to then invest it in real estate in this day and age with the new rules the liberals are doing is probably not a great tax strategy. Can dividends be paid tax-free between the entities? Yes, they can, and we did talk about that earlier. So they only flow dividends only flow one way, right? Because you give dividends to a shareholder. So when you incorporate this new operating company, you make the shareholder the holding company, which allows you to do dividends up to the holding company, and those are a special type of dividend that are tax-free. Uh, you meant assets, sorry. Yeah, sorry, that was related to the other question about property. Yeah. And then can losses in one subsidiary offset profits in another? What are the rules for loss carrybacks, carry forwards, and carrybacks? So the loss carry forwards, loss carrybacks are going to be the same. So you can carry back a loss for 3 years, and you can carry it forward indefinitely. So let's imagine that you have now, and what we should also be clear about is capital losses can only be applied against capital gains. So if you have a big capital loss and you have a bunch of operating gains, you can't apply those against each other. Now, can you move a loss from one company to another, or offset the loss? No. Well, yes and no. So I would say that you can't have a loss in one company and a gain in the other and have them offset each other. But what you could very much do is you could leverage the creativity with your things like your salary or things like home office, so that you're able to make one company more profitable and bring them up to parity, so that you don't actually have a loss in the other company. You actually have break even or a small profit by just moving around which company claims things like home office or salaries and stuff like that. And so you're not going to be able to, like, if you actually truly generate a loss and truly generate a gain, you're SOL. But you have, and this is the whole benefit of a holding company, is that you've got the ability to control. Okay, well, I'm going to rationalize and justify why these expenses go in this company, and be a little bit more creative. What is the implication of having a home loan in an opco that I want to convert into a holdco? Does the home loan transfer to the new opco, or does the home loan remain in the holdco? So the home loan would remain in the holdco. The only implication that you have is that in order, like if you have a home or an auto loan, there is a taxable benefit that must go on a T4, and a T4 and a home loan and an auto loan are employee loans. They're not shareholder loans. So you must remain an employee in that holding company, which would normally make sense anyways, because again, like we said, we're typically wanting to use salary to reduce the income of the investments to not pay tax on it. Now, in a situation where it didn't make sense, you could still keep a very small salary and keep the majority of the salary in the other company. So what you might end up with, and it's not uncommon when you have a holding company, is now you end up with two T4s. So you have a T4 from both your holding company and your operating company, where you're getting a portion from one company and a portion from the other. So the assuming that you're going with a method where the operating company becomes the holding company, if there's a home loan in existence, that goes and remains there. There are ways to move things around if it was completely necessary. But what I would say is, if it was necessary, it probably wasn't necessary to set up the holding company, because you probably don't have enough investment income to offset the additional costs, if that makes any sense. Oh. Excellent. So I think we got through all the questions that have come through. I'll give it another minute in case there are any other questions that come up here. But this Q&A stuff is great. Glad it was helpful. And if you have any other questions, again, I recommend sitting down with your account manager to go through your personal situation to determine if it's going to make sense. And again, big thing what we're looking at here is what is your track record of investment income. The hard part here is that can vary quite dramatically from one year to another. And the other thing that's important to know and understand is the difference between an unrealized capital gain and a realized capital gain, because you're not paying any tax on any unrealized capital gain. So if you have a bunch of investments and they've gone up in value, but you're not selling those, you're not going to have a taxable event, which means that you may not get the benefit out of the holding company. Thanks, Rachel. And I figure we'll try and figure out what's going on with Zoom and why I couldn't get this live. But we'll at least get the video, which we do have a recording, and we'll get that up and shared on social media. But we definitely got to get that figured out. So, Rachel and Kasim, hopefully you can help me figure out what the heck is going on. But everyone else, thank you guys for joining us. And again, what we'd love to hear from those of you who are joining, what type of content would you like to see? We're committed to doing these webinars every 2 weeks. We do our best to make sure it's content that's helpful to you guys. And this is our way of giving you an opportunity to come and connect with us, ask your questions, and hopefully provide some useful information. And we'd love to know from you guys where we could do a better job of that. So if you have any feedback, please don't hesitate to share. And without further ado, I'm calling it a day. Bye for now, everybody.